Hi everyone, good morning. Thank you for joining us on a Saturday morning. And we're very happy to welcome you to our first webinar, which is going to happen on the Corporate India's result update. We have Mr. R Balaji with us, who's the co-founder and CIO of FPS Assets. And as you would all know, Mr. Balaji has more than 2 decades of experience across fund management, wealth management, and equities, public equities as well. So today we will be looking at an insightful session on our take on FPS Assets take on corporate India and its results, and a little bit of a brief about what we do as well will be part of this session. Mr. Balaji will be taking you through that as well. So welcome you all. Thank you again for joining us. Let's go on to the meeting. Over to you, sir.
Hey, thanks, Ganesh. Thanks all for joining in a virtual webinar. I think it's an interesting phase, right? Where last 12 months, the market got consolidated. Finally, GST cut has come and market is trying to go up. So we thought it's very interesting phase to talk about corporate India. And I've been doing this for the last few years. So quickly diving into it. If you look at, one second. The four things which we're going to speak on is one is the mega trend, which is driving these earnings, the earnings cycle at this point in time, the Q1 results numbers, and the outlook. So these are the four broad things which we're going to see over the next 35 minutes. Coming to the mega trend, the biggest trend as an investor which we are riding is the India's GDP growth. If you look at India's GDP was close to 38 to 40 lakh crores 2 decades back. We moved to 87 lakh crores to 324 lakh crores. And I think next 5-10 years, it's going to be much higher. So as an allocator of a capital, what we bought, or as an investor or a consumer, what we bought between 38 lakh crores to 87 lakh crores is very different to 87 lakh crores to 324. So when we allocate capital, we need to see where India is going to spend money rather than where India has spent. That's point number one. The second, very interestingly, is India being the largest stock per se, right, has grown at 10% for last 23 years, reflecting a very robust growth for a very long period. So anybody who wants to be bullish on India, right, this one data gives you a good evidence about India has been growing. India has been growing steadily. And I think we are poised for a much bigger growth over next 10-20 years. Having seen the India GDP growth, the next important relevant metric which we track at FPS Assets is what is the entire market cap, which is 462 lakh crores. But within this 462 lakh crores, if you look at BSE 500, 88% of the market cap comes out of BSE 500. So what it reflects is, as an allocator of capital, if you monitor BSE 500 alone, close to 90% of the market is captured. And I think it's good enough for a lot more investors. The big picture followed by GDP and the BSE 500, right? The third important thing is what is driving the market. The last 20 years, if you look at Nifty earnings growth, which is one of the biggest barometer for both from domestic investor and the FII, has grown at 12%. Nifty market value has grown by 13%. I think we can comfortably say there is a close to 1-to-1 correlation between the earnings growth and the value growth over a long period of time. Definitely in the short period, markets tend to perform little faster or slower than the earnings growth. But eventually, if you are a 5-10 year investor, the most of the bulk of the money should come from the earnings growth. And India has delivered close to 12 for the last 20 years. So having seen the GDP growth, how BSE 500 creates a value, how the Nifty earnings growth has happened, why we are very bullish is I think India is not only going to grow from a 3.5 trillion to 10 trillion economy, it's going to sustain for multiple years. Primarily, one, the demographic dividend, the age of the Indian society is very young. It's going to create a lot more opportunity for all of us to serve. And if you look at infrastructure, right, last 10 years, we have significantly improved both physical infrastructure, which is road network, rail network, and the digital infrastructure. I think no better example than what has happened with UPI. The way we transact money, the way we spend money, the way we save money, everything has changed. I think India has clearly built a very good infrastructure to have a very sustainable growth for next 5-10 years. Once India, when you're going to grow from a 3.5 trillion to, let's say, a 10 trillion economy or a 20 trillion economy, the opportunity set is going to be a little more different. So here we're going to call out few new opportunity which we clearly see going to be a decadal opportunity. One is financial sector. A very interesting data from 361 annual report. If you look at GDP of US, right, which is 27 trillion, but the financial assets is 135, close to the factor of 5. Typically, every developed nation, the GDP to financial asset ratio is close to 4 times. But if you look at India, currently it's close to 2 times. We are broadly a 4 trillion economy, and financial assets approximately close to 7 to 8 trillion economy, right? But what is the broad projection is this 4 trillion or 3.4 will go to 30 trillion economy in next 2022 year period, and the financial assets will become like a 120, so factor of like a 20 times. So any investor who is looking at a 10-20 year perspective, we clearly see financial sector is going to be a big opportunity. In the financial sector also, if you look at banking, which we have done enough, mutual fund 5 crore investors are there vis-a-vis PMS of a 2 lakh. So clearly India is going to do beyond banking, little bit beyond mutual fund into a PMS, AIF, SIF, REITs, global, everything is going to happen. So there are a lot more fee-based companies are going to come up in India, which is going to create a lot more opportunity as an investor. If you look at the second biggest opportunity in finance is the pension market. And India, as we move in next 10, 20 years, one of the trends we are going to see is we are going to age as a society. And that comes the challenge of the pension, right? Retirement money. And if you look at the penetration, extremely low. Typically, a well-developed nation, the penetration of a pension market will be close to 1x of the GDP. In India, it's close to 3 to 4. So as a FPS Assets, one of the biggest positive area we are going to work, solve people's problem is how do they allocate capital today with less reinvestment risk so that over next 10, 20, 30 years, they are able to generate returns sufficiently to have a very sustainable living. So that is one of the core area of FPS Assets. The third big opportunity, apart from finance, is the overall opportunity of world is getting older and also prosperous. Very interesting data came from Corporate India or from TBO.com, which is a travel agency company. The fertility rates, we know that it's going to go down. It's going to create a lot more challenges. New business model gets evolved. Lifespan is getting longer. I think this is where buying into an asset with a low reinvestment risk is going to be very critical. And that is one of the opportunity which we're going to address to all our investors. The third, the world is getting more prosperous. At the same time, very, very interesting data on the work hours. The work hours has actually come down from 20 to 2,200 hours per year to close to 2,000, and the trend is going down. So we are going to have a period where people are going to work less, people are going to age, and people are going to have a lot more money. So I think when you have this mega forces playing, there are new business will get created in next 10, 20 years. The last mega opportunity which we want to talk to our prospect investors and the shareholders is the nuclear, which we clearly see Corporate India has also been speaking quite. And last 3-4 years post-COVID recovery, the huge growth of renewables, both solar and the wind, has helped us. But with advent of AI, one thing is very clear: power demand has gone up significantly. That is where nuclear is going to play a big role to support the power demand. And no better company than NTPC, which is going to start their nuclear journey, and they're going to hit 30 gigawatt in next 2020 year, where India also have a target of 100 gigawatt. To put in perspective, current nuclear power capacity is less than 10 gigawatts, right? So we are going to expand our power capacity using nuclear technology less than 10 to 100 in next 20 years. And that's going to create phenomenal opportunity in multiple terrains. And you will see a lot more new company, engineering company is going to benefit out of this big opportunity. So having seen the India's growth, having seen how the Nifty earnings have happened and all, now let us see where are we in the earnings cycle. So one of the very interesting framework which at FPS Assets we have built is how Corporate India balance sheet is positioned. This is on this one. If you look at row wise, right, low, medium, high, and the corporate earnings momentum, low, medium, high. So if you look at year 2022, 2023, and 2024, classic year where balance sheet strength is extremely high, earnings momentum is extremely high, right? A phenomenal place if you are an investor, right? Moving on to 2025, 2026. Balance sheet strength is good, but earnings momentum from high, it moved to low, right? Clearly reflecting the earnings growth slowed down. And if you look at 2025, we had an earnings growth of 7% at aggregate market. 2026, the broad expectation in the beginning was close to 13, 14. Currently, the expectation is 9%, right? Single digit. But very good news from our investor point of view is 2026, 2027, the corporate strength continued to be high. Earnings momentum is going to improve from low to medium. This is the opportunity which we want to address to our investor and tell we can be little more positive than what 1 year behind, right? So things are going to get better from now onwards. Definitely, GST cut is one of the catalysts giving us confidence that 2026, 2027 earnings growth going to be reasonably healthy, double digit. So having spoken about this three, right, how high earnings growth to a low to a medium, let us give some evidence about, right? So if you look at the Nifty 50 sales growth, the 2021-22 period, we had a very high growth. So this is what I put it in the bucket. But eventually the last 1-2 years, the sales growth has come to close to single digit. So those who are expecting a very high return of 30, 40, 50%, I don't think India corporates are delivering that type of a growth for us to sustain.
So if you look at the net sales growth, right? So I want you to focus on two things. One, if you look at 2021, a lot more whites have been seen. So we know that COVID lockdown hit a lot of corporates and they were not able to do better business. But once the lockdown got opened, 2022, we saw a lot of green, and 2023, interestingly, except two corporate, most of the corporate delivered significant growth, reflecting economy opened up, corporate did extremely well, and that got reflected in the market. Going on to the same slide, the balance, another 25 corporates, right? Interestingly, if you see this place, Power Grid, all NTPC or ONGC, Power Grid, Reliance, right? 2022-2023, we had very few, but slowly and steadily, we saw a lot more white, clearly reflecting the economy post the recovery of 2022-23, it got slowed down. So one of the question of why market been consolidating for last 1 year is, this is the reason, right? Corporate India currently delivering between 10 to 12% growth. So it is not a very, very high growth for us to deliver very higher return. Having seen the entire India growth, having seen what the earnings trajectory, let's get into the deep dive of how Q1 results played out. The first data which we want to bring it out to you is the market segmentation between large cap, mid cap and small cap. The overall market cap of BSE 500 is close to 406 lakh crores. Large cap is 68%, mid cap is 21%, small cap is 11%. One of the things which, when we look at portfolios, right, if the entire market is 70% large cap, as an investor, we should not invert this and say, we see a lot of investors have 60-70% to small cap. I think we need to understand the market structure. We can have little more aggressive bet. So instead of having 11%, as an investor, we can have 20 to 30% in small cap. But having only a small cap of 60-70 brings its own vulnerability. And I think this data gives you where the current market capitalization is placed. Coming to the sales, right? One of the biggest driver of value, the large cap sales is close to 27 lakh crores, mid cap is 7.75 lakh crores, small cap 4.32. And aggregate sales of close to 39.67 lakh crores, right? This is for the Q1. The growth of the sales of the BSE 500 is close to 6%. So this is what corporate India has grown. But very interesting data on the large cap is grown at 6%, mid cap has grown at 8%, small cap, contrary to expectation that they tend to grow very fast, they have grown only 4%, reflecting at a broad small cap level, the growth is slow. Obviously, few small caps have delivered significantly well. So when we allocate capital, you have to see the big picture, because over a period, with mutual fund size is running into 30, 40, 50,000 crores, one of the problem is they're going to own the market and the performance is going to mimic the broader trend. So I think this is a very interesting data from an investing point of view. Small caps are not growing significantly superior to large cap. To double click the same data, what we have done is we have divided the entire sales of 47 sector into sub-segments and how they have grown. So the aggregate growth is 6%. But if you look at why this is only 6, no, the biggest sector, which is oil and gas, banking, automobile, IT, insurance, everything has grown sub 10. Finance has grown 17. One interesting sector which is for the reasonably big size has grown well is telecom. And we are clearly seeing the benefit of data. We are consuming it and we are actually the ARPUs are rising. The few subsegments did extremely well is electricals, reality, hospital, and bit of business service. So if you look at the topmost sector with high sales have not grown, subsegments have grown. So obviously the opportunity still exists, but it is limited in nature. The same data, what we do from FPS Assets is we divide the 500 company into the different buckets of sales growth, less than 0%, 0 to 10, 10 to 20, greater than 20. And there's a very interesting ratio which I continue to track called high growth to low growth. High growth is all about company which has grown more than 10%, which is basically 10 and 20 and greater than 20. Low growth is less than 10. So giving one example, if you look at automobile, out of 45 companies, close to 17 companies has grown better sales. Balance did not grow well. So the ratio is 0.61, reflecting for every one company which has not grown well, 0.61 company did well. So basically the sector is not doing great. Vis-a-vis, if you look at a sector like electricals, 5, reflecting for every 5 good company, there is one company which has not grown. So reflecting again momentum in the sector. So by looking at this data clearly as an allocator and a distributor of a capital, right, from our investing to all the assets, we can find sectoral fund ETF using this data and allocate capital wisely to our investors. Same thing like a sales, what we have looked at from the PAT, right? So PAT, aggregate PAT of the BSE 500 is 4.2 lakh crores, 12%. Interestingly, sales grew 6%, PAT grew 12%, reflecting corporate India is able to get better margin, and that is what getting reflected. Large caps grew 12%, mid cap grew 18%, small cap again as -1 or close to 0, reflecting the underlying slowdown in the economy impacted a lot more in small cap rather than a mid and large cap. The same data of how we saw in the sales, we have dissected by sector wise, which sector it grew very well. So the banking, which is the largest sector in terms of profit pool, did not grow. So that is one of the pain point. This is primarily due to the entire rate cut induced by the regulation, so that we have seen a margin pressure happening and the credit growth is also subdued. But interestingly, as an allocator of a capital, this is the window which we are very keenly working, and we clearly see next 2 years, this data is going to improve and going to throw a lot more opportunity to use index funds and ETF and particular funds to capture the emerging growth out of banking. And if you look at IT, close to 10%, automobile -1, healthcare -4. So broadly, again, bigger sectors had a very subdued growth. Few of the sector like electrical, which I told in the past, sales also did extremely well. Profit growth was significantly. But again, right, there the performance is currently coming, but the valuation challenges are real. So when you deploy money, we need to look for sectors where growth is going to come next 2 years. At the same time, valuations are palatable, correct? Same how we look at the sales, we keep looking at the PAT where the growth is getting sustained, growth is getting broad-based. So if you look at business service, for every one company did not do well, 3 companies that did well. And if you look at automobile, for every one company did not do well, 0.88 companies did well, right? So clearly by looking at subsegment, we also can identify opportunities like how we looked at sales data. The last slide out of the earnings growth is our fantastic 16 quadrant slide where we have divided the sales growth into 4 buckets, less than 0, 0 to 10, 10, 20, greater than 20. Similarly, PAT. So if you look at, we have colored green, these 4 quadrants, and another orange and 4, and the rest is white. So the green reflects, these are the 159 companies which has grown sales more than 10%, profit more than 10%. So if you have invested in a fund or in a PMS, what we want to evaluate is, does the PMS capture this growth when we do a portfolio review, right? At the same time, if you have to look at where the opportunity set can open up from an investing point of view, either using an ETF, sectoral fund, or a diversified fund, is the space where currently the numbers are not great. Hopefully the valuation should have been palatable, and that is an opportunity to allocate capital. So every single quadrant gives you one idea where, so the 75 tells you neither sales is growing nor PAT is growing. So this is a bucket. If you are looking from an investing point of view, generally the interest should be very low. And this is the bucket, which is 68 should be the bucket where the general interest should be very, very high, right? So this 16 quadrant gives us a good idea about how to play about allocating capital in a various subsegments of the market. So having seen the growth of the India earnings cycle and the result, the last segment is the outlook or what has changed. Why are we feeling little more positive today and why we think there is more opportunity lies today than what the 12 months before? The first thing is the expectation reset. Clearly, the expectation was running high 1 year back. Now the reset has happened. To put in perspective, 26 initial estimate of EPS growth of Nifty 50 was 1200, and slowly when the disappointment came in, today it's close to 1100. I think we are very close to the reality, right? So one good news today, the expectation is close to reality. So that's the first point. The second point, I think good amount of selling from FI is almost done. We are clearly seeing definitely selling is continued, but not at a significant rate. At the same time, domestic flow continued to happen. The third, given the time of 1 year consolidation, bit of earnings growth and bit of this time adjustment, we are seeing today valuations a little more palatable than 1 year back. Clearly, we are not a cheap market. So clearly those who are expecting a very high double digit like 30-40% type of a return, I don't think this environment is well suited. We are in an environment where a strong or what to say a healthy double digit is what somebody is looking from a medium term point of view should think about and coming with a 4 to 5 year outlook. Valuations are reasonable in the large cap and selective mid and small cap. Why valuation do matter is there's a very interesting work done by the Michael Mobazin and the team in terms of putting out there is a direct function of starting valuation and the forward return. And I will run you through one interesting data using Coca-Cola. Great stocks don't always remain great. This is a Coke's chart for a 40-year period. We saw continuous 20-year rise in the Coke, but then eventually for last 20 years, it did not perform. So one of the key message when we allocate capital to using index funds, ETF, or the sectoral funds, or any specific stuff, right? We need to look at from growth is getting better, ROE is getting better. At the same time, valuation should be palatable. If we pay up significantly, the price we pay at some time could be extremely long period of consolidation, right? So this is the data, right? When they grew very well, the reward was very good. But when the growth slowed down and the valuation was very high, we saw a period of close to 20-year period of a very, very muted, right? So winning stocks are good. We should appreciate the winner, but at the same time, when we incrementally deploy money, we should be aware of the valuation risk. And finally, on the asset class performance, if you look at 1 year back, the biggest asset class which was performing very well was small cap index, which was at 50%. And slowly post December, the market fell. Gold has become the favorite, right? So one of the questions keep coming back to us is the right time to look at gold? But clearly, people who have invested in the gold 2 years back reap the benefit. Maybe this might not be a very, very appropriate time to allocate a lot of capital in gold because we clearly see the easy money is being done. Maybe it's a good hold or at times maybe you need to go for an exit. So what are the growth initiatives which the policymakers have done and why we are very positive? The first growth initiative is the monetary policy. Clearly, we are seeing the rate cuts have happened, liquidity got better, regulation is getting better. We recently saw the tax cut in the budget as well as the GST cut, which is going to produce a lot more consumption. NBFC credit growth is expected to accelerate post the easing cycle by the RBI. And finally, government is also pushing full throttle on the capex from the government side. I think clearly we have hit the low point of GDP growth. As a house, as an FPS assets, we are clearly seeing in next 12 to 18 months, the growth is going to get revived. From H2, we will see some more evidence and clearly post Diwali and December, right? We're going to see growth data is going to get better across the board. So if you look at why we can be a little more positive in a three-way framework, 2024, 1 year back, quality of balance sheet was good. Growth was peaking and going to go down. So it is in red. Valuation was also risky. But cut 1 year, quality of balance sheet is good. Growth is going to get better, which is in green. Valuation is okay. So if we have to be positive, today is better time to be little more positive than last 1 year. To conclude, How to think about future market return? I think we clearly see market return is going to converge close to India GDP growth. So if you look at a return for a longer period of time, the investors have done close to 10 to 12%. So a very good way to think about return is, I think India's GDP growth plus 1 or 2% is what a long-term equity asset like an India should deliver. Obviously, if you can act well, allocate capital when there is a lot more pessimism, and stay invested, I think your return can little more benefit. But I think anchoring yourself to 10 to 12% is a very good way to think and then structure the portfolio. And I think this data clearly brings out what a long-term return has happened. So the 2005 investor who started, the first year return was 36, second was 38. So a lot of excitement. But eventually everything drained out. And if you see in the 20-year period, they've also compounded at a rate of 13%. So clearly reflecting over a long period, this is type of an expectation is what we want our investors to have. To conclude, economic cycle is okay, earning cycle is okay and expected to improve in H2. Moderate your portfolio risk in terms of concentration in one segment. I clearly see one of the big risks for the market is participants are trying to look for the same segment which worked well in the last 2 to 3 years in the next 2 3 years, right? It might not happen. So clearly the opportunity is getting opened up everywhere. And we saw gold, right? I think last 2 years back, there was no excitement. And suddenly you see Indian markets have been very flat and gold is going up, right? So I think as an allocator and as an investor, you should definitely diversify your holding and look for the newer opportunity. The third point, consolidating market gives you to build a good future focused portfolio. I think last 12 months market has been consolidating. It is going to help all of us to relook the portfolio, review the portfolio and build a future focused one. Sales is going to be the biggest driver of value going forward. And finally, risk reward is going to be a little more favorable in a larger market capitalization company and a selective mid and small cap, because if you see last 1 year, few segments of the market got corrected and that opportunity is getting opened up. I think with that, we are very, very happy to introduce our offering. So basically, FPS Assets, we just set up last 2 3 months back with a couple of my partners. So we are offering a wealth distribution in terms of right from equity mutual fund, debt mutual fund, ETF, insurance. Our whole idea of setting up FPS Assets is, I think every individual have their own unique needs and the opportunity set is getting wider. To put in one perspective, SIF as one asset got created recently, right? So we clearly see the window is getting opened up. And with our capability into past, I worked into fund management and worked into advisory and the research, right? So we are an investment focused organization trying to serve a lot more people who wants wider asset to build their sustainable wealth. With that disclaimer, definitely right. This entire material is from my education perspective. I think any future statement has to be construed keeping the limitation of it. Thank you. Thanks once again. And any questions, we'll be very happy to answer.
Thank you, sir. I think we can move on to the list of questions. I've consolidated a few questions from our viewers so that we can answer them one by one. So the first question is, where is the risk in the market today? So something on that.
Yeah, it's a very interesting question. I see the risk to the portfolios are coming from very concentrated holding, either in a PMS or one fund house. I think clearly, right, we have to reduce that risk. I think people are getting over invested into a particular segment of the market, which did extremely well in 2022-23 cycle. And currently the search is also the same place, right? I think what investors should look at is they have to use all the opportunity available in the market rather than trying to find opportunity in the only area and an area which has worked well. So to give one example, gold, right? Clearly, gold as an asset has done very well over a long period. It's a very good diversifier, no second thought. But today the excitement levels are very high. But if you look at from a forward IRR point of view, I think the easy run in the gold is done, right? So from our perspective, we clearly see gold might be a good hold and possibly gold and gold related funds, right? So there is one fund house which invests only into gold mining stocks, delivered close to more than 100% return last 1 year. But if you see historically, right, these funds tend to do 100% and then go down to close to 0%. So maybe this is a time to keep a watch. This is a time to ask tough question about how to reduce risk using trimming out of the portfolio, right? That should be the right question rather than asking, should we now add more into it after a significant rally, correct?
Okay, sir. Got it. So another question is on the sector-specific question. So which sector is going to drive earnings growth is a question that we have right now.
I think clearly the first major sector is going to be banking. If you look at credit growth, right? So we were growing between 20% odd to 17, 18%. Then the tightening happened. Today, the credit growth is close to 10%, which is close to nominal GDP. But clearly in the last 6 months, if you have tracked RBI regulation and the policy and the liquidity, it's all pro-growth positive, including the GST cut. So I think credit growth is expected to move from 10 to 12 to 15. So FY 26 to 28 earnings growth of typical large banks are anywhere in a very healthy double digit. So I think that is going to drive. And why banking growth is very important is banking is a 37% of any major index, right? So when banking revives, the entire market earnings growth revives. So I think we clearly see that growth coming in. And I think hopefully post Diwali, you will be able to see credit growth numbers picking up. The second very interesting is the urban growth. Post GST cut, I think very clearly the money is getting infused into the society. I think this is going to push up the growth. Already rural India is doing good. So there are two segments where we are very positive. One is consumption. We clearly saw post-COVID, the investment-led growth driven the market. Today, the government is focusing on consumption. So consumption-led growth is going to drive the market. Banking is going to drive the market, and rest of the segments is going to support the market. I think these are the two major drivers of the earnings growth in the next 2 to 3 years point of view.
Right. So now there's a question on the IT sector. How our views on the IT sector and the outlook.
Again, a very interesting question on IT. If you look at IT is one of the most profitable sector per se, right? If you look at the balance sheet, if you look at the ROE, free cash flow. So I think a lot of people get very excited about the quality of the company. Undoubtedly, they are phenomenally great. But the challenge is high ROE with no growth doesn't mean anything, right? From an investing point, because as an investor or as an equity investor, all you're looking for the growth. And if you look at the last 20-year data, very structurally, IT dollar growth is coming down, right? From a very healthy double digit to higher single digit to now a mid single digit, right? Close to 5-6%. So the challenge is if the rupee is not going to depreciate over next 5-10 years like the way we have depreciated, and the dollar growth is 5-6%, we're actually looking at an environment over a long period earnings growth of close to 6 to 7% on a normalized basis. With 6 to 7% in a growth economy, right? So typically IT is going to be a lot more like a trade rather than a buy and hold. So we clearly see, right, people over invested in IT using IT funds. I think we need to revisit the perspective, and that is one of the things which we want to share it to our investors.
Sir, you've already spoken on gold. There's a question on gold and silver. I think maybe you can cover on silver this question.
I think, coming to gold also, right? As I told, gold is a good hold. Definitely, there is a lot more catalyst playing out. But I think the easy run is done, right? We have seen a significant rise from at least the recent rally was significant from $3,000 to $3,600, right? But silver is catching up. So I think what is very interesting is when gold and silver has caught up, there are certain other commodities are becoming very interesting. So as an allocator of capital, right, what we are trying to use is we are using various ratio and see, is there any other commodity like an oil, which is at $60 today, close to it. And if you adjust it, right, oil to gold ratio, all, it looks very, very palatable given the medium term outlook. So I think the risk to reward looks a little more better in some other place. But if you're holding on to gold, I think you can continue to hold on. But I think this is the time to hold and possibly to exit and not to invest, both gold and as well as silver. Silver has little more material industrial use. So because of Fed cut policy, growth can revive. So silver can have little more longer run. But I think these are more like a, I would say, mid-stage asset rather than early stage asset. Definitely gold has passed the early stage asset in the last 2 years, right? That's why we have seen already significant rally happen both as a commodity and as a price of the gold stocks, gold mining companies globally.
Right. So we have the final question is on the FPS Assets organization. How is it?
Yes.
How is FPS Assets different from other wealth management firms? If you could give us a view on that.
I think FPS Assets for us, it's all about an investment-led organization. So if you typically see predominantly a sales-driven organization is what built in, we clearly have built the organization keeping investment first, right from me having a broad research experience, fund management experience. I think this is the first time where somebody who have run the fund got into an asset wealth distribution arm in terms of we are going to distribute all the regulated funds with our partners. So I think we have heavily invested into investment team currently itself. And finally, I believe the proof of the pudding is in the eating, right? The way we execute about it. People who have experienced in my past experience into the fund management also clearly saw the way to build portfolios. You take low risk and deliver sustainable outcomes. And I would say we will drive cost leadership. So one of the offering which we are going to come out to our investor is we are going to come with an exclusive product to our investor in some point in time, which we want to reduce the cost by 30-40%, and it's going to be alpha product. So I think we are going to bring unique products from a distribution of wealth, and we're going to drive the cost down, and we want to take low risk and deliver value. That's our belief system. And I think finally, right, how we deliver is all about building a good solution, not only gets performed in the next 3 years, but maybe a next 5 to 10 year period. And any particular question on this, we'll be very, very happy to answer. I think both our colleagues' numbers have been put out in the last slide. Once you reach out to them, we'll be very, very happy to serve you. Looking forward for your continued support. Thank you. Thanks, Ganesh.
Thank you. Thank you, sir. So thank you everyone for joining us today, and hope you had an insightful session on what we do and how you can look at corporate India for the forthcoming quarters. And like Balaji said, you can get in touch with us with our coordinates, which is on the screen right now. So you can either phone us up or mail us with your questions or any queries, and our team will be happy to get in touch with you as soon as possible. Thank you all for joining us today.